The following podcast was recorded on Tuesday, December 21st, 2021, featuring Jim Bianco of Bianco Research. To hear the podcast in real time, you can sign up for a free trial at biancoresearch.com or arborresearch.com, or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to the latest edition of Talking Data. I'm your host, Kristen Radosh of Arbor Research and Trading, joined today by our presenter, Jim Bianco of Bianco Research. Today, Jim answers the question, does the Fed have a choice? Jim, the last 13 years, whenever the economy or markets get wobbly, the Fed would inject massive accommodation and a recovery would ensue. That was possible as inflation never materialized, but that's not the case now. What's the latest with inflation?
Yeah, and thank you. That's right. That is what has been the case. So if we look at the first chart, this is what I would argue is the game changer that everybody needs to know that is different from the last 13 years, is that we have a 40-year high in inflation. The Fed has retired the word transitory, although the consensus still believes inflation is transitory. We at least have high inflation prints. That's something that was never present since 2008. That's why I went back 13 years. Since the financial crisis, when everything got a little wobbly, as you mentioned, in comes the Fed, the vernacular would be that they start printing like crazy and everything goes up and everybody wins, the economy expands, unemployment falls, markets respond well to it, nobody loses. And now I think that the big change in the equation is this chart that we have inflation. And as we move forward from here, I think it's important to understand the narrative of inflation and what I think the reality is going to be in 2022. The reality is going to be that this number that we're seeing with inflation is probably going to peak probably by March, maybe April at the longest or so. And it might peak with an 8 handle on it. It's at 6.8% now. So it could definitely go into a 7 handle or maybe an 8 handle before it peaks, to be determined. And when it peaks, everybody will do what they always do on Wall Street, go, it's over, it's over, it's over. You could forget about inflation. And that's not gonna be the story. The story is gonna be how fast does it come back down, because inflation's gotta get back to the low 2s for it to traditionally be over. And I think that what we're gonna find through the balance of 22 is that this decline in inflation is going to be slow, and it's going to keep it at an elevated and a very uncomfortable level. And that's what's going to be the difference between the last 13 years and now, is this inflation story.
So what are the consequences of inflation?
So as we've had in the last 13 years, there was no consequence, right? Because markets fell, economy fell, Fed pump, market go up. But now the consequence is in politics, and it is in what's happening with, and I want to say this in a nonpartisan way, because if the other party was in charge, it would be the same, the Democrats. So if you go to the president's approval rating, his approval rating has been falling all year. Now there's a number of reasons why. You could go to your favorite political blog and get all of those reasons, but one of these reasons that has been stated time and again on these polls is high prices. Let's remember now, 40% of the public rents and does not really have any kind of savings other than maybe $500 or $1,000. They don't have a stock portfolio, they don't have a home. And so they're not seeing the ascent of asset prices as a benefit for them. What they are seeing is 6.8% inflation, and their paycheck, although they might have gotten a raise because wages are going up, they're not keeping pace with inflation. So they're seeing their paycheck buy less gas, buy less groceries, buy less staples. And they're very upset about that. And that is showing up in the polls quite a bit. And if you jump to the next chart, while the president's approval rating might be depressed for a number of reasons, the next chart shows what's called the generic ballot. And what that is they ask voters, in the next election, will you vote for the Democrat or the Republican? They won't ask you which race or a name of a person, just Are you a Democrat voter or are you a Republican voter? And so you can see in blue is the Democrats, and in red is the Republicans, and in green, the bottom panel, is the difference. And that's Democrat minus Republican. The way I put that difference, it's always above zero, meaning that we've always got a net Democrat vote, at least back to 2017 when this chart started. But look at the last 6 or 8 weeks, especially since November 1st. Two things have happened since November 1st. One, the public has said in a number of polls that rising prices is now the #1 issue in the country, even more than COVID. There's been a number of polls that said that. And two, the generic ballot has now flipped to the Republicans. In other words, they're looking and they're saying, I don't like rising prices. This is bad. Who's in charge? Oh, the Democrats? I'm voting for the Republicans. And the reason I say that is I don't want to make sure that people understand it's not partisan, because if it was Republicans in charge and we had 6.8% inflation with these kind of wage growth, they'd be hammering them as well too. So this is what's got the urgency about inflation, and this is the constituency. So if you go to the last slide, this was a story that was in the FT. Democrats push for tougher action against inflation. I and many of you probably thought we would never see the day that a political party would be telling the Fed, raise rates now. That's exactly what they're doing, because they know that inflation is crushing them. And they know that they being the Democrat Party is crushing them in their November outlook. They need the Fed to stop rising prices. And so therefore, they're starting to demand that the Fed intervene and do something about rising prices. So the dynamic you have now is you've got the stock market on one side of the equation, and on the other side of the equation, you have Democrat voters, and mainly the 40% that have no savings or no home. So if you address the unhappiness of Democrat voters by aggressively raising rates and reining in inflation, the stock market might not like it. If you say, no, we can't do that because we might upset financial markets, so we'll go slower with the rate hikes, we'll go slower with everything else, the voters won't like it. And so we're in a difficult spot here where there's a big constituency for a winner on one side, I should say, and a big constituency on the other side.
So where does this leave the Fed?
They have a difficult choice to make right now. Which constituency are they going to address? My take is I think they're going to side with the 40% that have no savings and want rate prices to come back in. And that's why you've been seeing this in the way the financial markets have been trading. Short-term interest rates have been soaring. Today, December 21st, shortest day of the year, we're talking the Fed Fund Futures is now pricing in a 51% chance that the Fed's first hike is the March meeting. So it's the meeting after the January meeting, and then we're going to have a hike as well. The market has got roughly 3.5 hikes priced in as well. This stands at odds with, say, the Bank of America's fund manager survey that was out last week. 78% of the people in that survey said that the Fed would hike rates 2 times or less in 22. There's 3.5 priced in right now in the market. And the narrative, as I watch financial TV, is the Fed's not going to move 3.5. They're going to move less than 3. That seems to be the narrative, because the narrative is inflation is transitory. Inflation is going to dissipate sometime in 22. I think it's not. And like I said, I think it will peak. It will start coming down, and people will tell you in the spring, yes, see, look, it's coming down. I told you. Yeah, but it's still at 5. It's still at 4. It's still in the 3s, even though it's coming down. It's got to get to 2.0 in order for it to be a non-issue. And I think with rising owner's equivalent rent and shelter prices, and with the momentum that inflation has, it's going to be very difficult to get it all the way back to 2. And so the Fed will probably side on the side of those 40%, because they're also going to hear it big time from the Democrats if they remain very low in the polls. Add in Omicron. If we get a big spike in cases, what does that mean? I've argued, and I've used my words carefully here, it's going to mean restrictions. I don't say lockdown because first of all, I don't know what the difference is between a restriction and a lockdown. Lockdown is just such a politically or emotionally charged word that there will be some kind of restrictions. Maybe some of them are self-imposed. I have comorbidities. I see these cases. I don't want to go to work. I don't want to go out and spend money or something. Or maybe some of these restrictions are going to be imposed by political leaders. We're coming from Chicago, and today the mayor of Chicago is proposing that everybody has to bring proof of vaccination to go eat at a restaurant. Now it's become too hard. I'm just not going to bother to go eat at a restaurant. Okay, they're going to get less activity, is what they're going to do. If we get restrictions on the economy, we're not going to buy less stuff because most people are not concerned about Omicron. We're driving, we're going to sporting events and to concerts, and we're living our life. But if we get restrictions, we're still going to purchase, I think, stuff at the level that we're doing now. We're just going to have the ability to produce it, ship it, and deliver it being impaired to some degree, which is a fancy way of saying that that will be an upward pressure on prices, even more inflation as well too. And that will lead for the Democrats to stay depressed, to yell at the Fed, your primary mission is inflation, do something about it. And I think that as 22 unfolds, that we're going to see the market start to worry that the Fed is going to do something like hike rates too much and potentially break something. Two other measures suggest that the bond market is very worried about it, and I think a lot of people misread this. The low terminal funds rate, if you look at the forward curve of the Fed fund futures, it stalls out at around 175, which means how high is the Fed going to raise rates? 1.75. Now, a lot of people look at that and say, less than 2%, that must mean that there's no inflation. Otherwise, the Fed would raise rates more. No, I think what it means is that it would only take 175 to basically break things, whether it's the stock market, the economy, or some other plumbing part of the bond market, like the repo market in 2019 or something like that, and the flattening yield curve. Well, there's no inflation problem because 10-year yields and 30-year yields have been meandering sideways as short rates go up. Again, I think what that flattening yield curve is a signal of is we're running into a period where the Fed's going to be raising rates aggressively, addressing the 40% concern, and there's a high chance they're going to break something. And that's, I think, could be the narrative in the first and the second quarter as we move forward from here. This is not uncommon. We saw this in 2004 to 2006 in the market as well. The Fed raised rates 17 times, the 10-year went sideways, the curve inverted. Eventually they broke housing, and then we had the great financial crisis. I don't think we're going to have anything that severe now, but that is definitely where the risk is from here. So when we look at the bond market, when we look at the stock market, I think what we have to recognize is the market is trying to tell us the Fed's going to get aggressive. They don't have to go very much to break something. And the flattening yield curve is saying, yeah, they might exactly do that. Well, why? Why would they do that? Because when I put this on social media, people say, well, the Fed will never upset the stock market. Yes, because for the last 13 years, there wasn't a big important constituency on the other side of that trade. Now that we have inflation, there is. 40% of the public, most of which that vote for Democrats, they want the prices at the grocery store, in the gas pump, and at the shopping mall, they want those prices to stop going up now, not tomorrow, now. Fed, do something about those prices now. And yes, the Fed can do something about those prices because part of that is stimulus driven. It's not all supply chain driven. And so therefore they've got this other side of this trade. It's not just goose the stock market, everybody wins, nobody complains. And this is going to be a narrative that I think people are having a hard time getting around, and it's going to be what we're going to have to talk more about in the first half of 2022.
Well, Jim, thanks for your thoughts today, and thank you to everyone for joining us. As a reminder, Arbor Research and Trading is an institutional research and brokerage firm. Our two most prominent offerings are Bianco Research and Arbor Data Science. For further information, please contact Gus Handler at gus.handler@arborresearch.com. Thanks, everyone, and happy holidays.
Happy holidays.